So it's been really amazing to watch the growth of private capital in this industry over the years. I think for those of us who are kind of interested in the history of this, I believe it started with ship owners chartering to other ship owners. Please. And then ship owners started lending to other ship owners. And I think the first example of kind of non-traditional financing was Northern Shipping and DVB teamed up to form NFC. Anyone can correct me if I'm wrong, but I'm going through the history here. But it's been amazing, because I remember it wasn't that many years ago that this was sort of a small feature of the marketplace, the alternative lenders. But this market has just continued to grow, and it's become not only a big sort of permanent part of the market, it's become a very successful strategy for investment. And the guys we have on this panel they don't just do it. I mean, they really have helped kind of create and develop this market. So we're really fortunate to have all of you. And Dylan Potter is a partner at Vedder Price and knows the market as well as anyone. So really look forward to the discussion and where you guys are going to take this market next. So thanks for being with us.
Good morning, everyone, and well done for being here at 10:30 on day 3 of this marathon conference. So it's good to see so many of you here bright-eyed and bushy-tailed and ready for some excitement. We've got 30 minutes, so it's a short panel, so I'll just get straight into it. On my left, I've got Svein Engh from EnTrust. Next to him, I've got Antoniou, Managing Director of Neptune Maritime Leasing. Christoph Toepfer from Borealis, the CEO of Borealis, and then Ole Hjertaker. Thank you.
Close enough. Just call me Bob.
I do play the Australian card in that case, and we struggle as us Aussies sort of pronouncing anything that's longer than a syllable. So thank you. So I mean, this market has developed a lot. It's been a big part of the industry over the last few years. And the thing that's really interesting to me about the kind of private credit players is, the range of solutions that they offer ship owners, and the way that they've really supported the industry over that kind of period of time. But each of them are kind of developed their own business model. So I'd just like to start with each of you sort of describing kind of how you see the maritime sector and your investments into the maritime sector. What interests you? Kind of what gets you out of bed each morning and sort of gets you excited about the maritime industry? Where do you play in the capital structure? Those kind of things. So Svein, if I can kick off with you.
Thank you, Dylan. Well, first of all, thank you to Marie Money for inviting me back. It's been a few years. It's great to be back. So we started what we call Blue Ocean at the end of 2015, and we wanted to make sure that when we started this and structured it, that we had a very broad mandate. We didn't really want to be pigeonholed into doing just one thing. So the one thing, though, that we always are focused on is to be counter-cyclical. So what we do is mostly debt. About 80% since we started has been senior secured lending. But we can really do anything. And what we found over the years is that we actually end up either doing debt, and that's for the most part, or common equity. We do very little in between. We just find the risk-reward there to be unsatisfactory. So we just counter-cyclical, we provide debt capital to owners. What we try to do is to make sure that we are very, very efficient, very predictable. Execution is absolutely key. There's no doubt that we have a reputation of maybe not being the absolute cheapest out there. But I think we try to compensate by being very, very clever in terms of structuring and also in terms of being able to deliver predictably, efficiently, and also at this point, actually not incredibly expensive compared to what the perception was years ago as the rates have been moving up. So we have been able to deploy a lot of capital. We've raised a lot of capital. We have built a team. We didn't want to build this to be a trade. We wanted to build a sustainable long-term business. So we have a dedicated team, dedicated fund. So we basically do everything ourselves. We actually have now 15 investment professionals in our team. And if you look at the early days, it was really just 3 of us for the first couple of years, and now we're 15 people around the world. So in terms of right now, we do not see a lot of interesting opportunities on the equity side, so we really do mostly senior secured debt. In terms of sectors, We actually have now finally gotten into the offshore oil services sector. We really backed off that sector for years, but after the war and the energy security issues, we actually now are deploying quite a bit of capital in that sector. We're also looking to broaden our base. We're looking at cruise, we're looking at other things, but the bread and butter is still the commodity shipping, container ships, dry bulk, tankers, and so on. But with our kind of cyclical approach, there are certain sectors that we backed off from. For instance, container ships, we haven't done any transactions for the last 2.5 years or so, as that market went to incredibly high levels.
Thanks. Harris?
Yeah, thank you. Good morning, everyone. I'm the founder of Neptune Maritime Leasing. We started the company a couple of years ago, really, by tapping into equity from well-known shipping investors. And over the course of the last 2 years, as we expanded our team and we expanded our coverage, we added more capital. And we're very pleased that we managed to secure a very large round of funding from Costa Mare a few months ago. And continue to grow our business. Our business focuses only on leasing at the moment, so we don't work across the capital structure, but we're very focused on providing leasing solutions. And the reason for that is that we think it's the best risk-reward that we've seen over the past few years. As banks moved away and are moving away from funding the industry, because of regulatory reasons, but also because of the business model changing. This originate to distribute model through syndications, is not working as well as it used to. We saw ourselves with funding up that all of us here in the panel came to actually feel, and we felt that the right timing and the right approach was to focus on maritime leasing. So we're looking at the asset. We're looking at it from a technical point of view. We're looking at it from a commercial point of view, and then we move on, trying to provide flexibility, predictability, and of course, pricing which is attractive to our owners. And the reason we're able to do that is that we structure as a company. We're not structured as a fund, so we don't have end-of-life issues that a lot of the funds have to deal with. And as a result of that, we have an interesting support group between also the maritime lenders that are still out there.
Your question was, what gets me out of bed in the morning? A simple answer is shipping. Once shipping, always shipping. It's a fascinating industry, and we're slightly different than the other panelists here. We, as Borealis Maritime, what we do is we try to identify opportunities within the maritime space and match it up with institutional capital. We in Borealis Maritime, we have really two parts of the business. One is the Borealis side, which is really the equity side, where we invest into vessels in different forms. It can be opportunistic, it can be also more conservative into some kind of long-term charter contracts. And then we have the lending side, which is Australis Maritime, which Elias Sakelis is generally heading up. On the Australis side, what we do is obviously provide also funding, lending into the industry on a lease or loan basis. We try to be very flexible in terms of the structuring. Obviously, as an unregulated lender, you can really take a kind of opportunistic approach around how you structure the loan or the lease. We have a very deep understanding of the various asset classes out there. We generally have invested in these also on the equity side. We manage some of these assets on the equity side, so therefore we believe we have a very deep understanding of the asset classes and also where each of these asset classes sits in their current development. As an example, we took on the equity side, we took quite a constructive view of the offshore industry back in 2018. And we started investing into offshore at that time, and we started lending as well around at that time. So we were probably by far one of the earliest lenders into the offshore market again. In many cases, over the last 3 years, we were the only sometimes term sheet that some of these parties received for financing offshore vessels. Now, in the last 6 months, we see some of the other colleagues of ours appearing into the offshore market as well. But that was, for example, something where we saw an overall constructive view of an industry, and we started lending against these assets where a lot of other people still were very much holding off and not wanting to build exposure to offshore. So yeah, we're slightly different, but it's exciting. There's always changes. Everybody seems to be super optimistic right now about the next 10 years almost. I think Ole Hjertaker described it yesterday as dry cargo and tankers as risk-free investment right now. I am not so sure. When everybody is too bullish, I always get a little bit nervous. Obviously, overall, it looks pretty constructive right now with the fundamentals. So that is good for the lending side as well as for the equity side as well.
Great stuff. Thanks, Christoph. Ole?
Yeah, thanks a lot, Ole Hjertaker, CEO of SFL Corporation, and it's so much fun for once to see an audience and a panel where nobody's bankrupt, because that's the norm, in our little market.
I don't know. With this kind of audience,
oh, you make money off it, do you? Yeah. Under restructurings. So you this is a downturn, is it?
We do well on the way up and the way down. But this panel, this type of panel in the past, we've talked a lot about kind of distressed debt, kind of portfolio acquisitions, those kind of opportunities it throws up. So it's great to be in a situation where we're talking about a positive industry and the developments there.
Well, yes, and we've had our share of restructuring. So I've been in SFL since 2006, and there's been some ups and downs. But just to sort of illustrate, the difference between us, SFL, and my fellow panelists here is that with SFL, you can go in and out. We have $50 million share turnover per week. With these guys, the money is trapped for 5 to 10 years. And our G&A, effective G&A per invested capital is like 0.3%. Well, I guess these guys probably charge 1 to 2% fee plus 20% kicker, like Christoph.
But we don't. We're not below NAV.
So where do you want to put your money?
Who invited him?
We're not below NAV as most of.
Talk to those guys down there.
No. Joking aside. The company was called Ship Finance originally, had a very sort of bareboat finance type profile. My experience over these years is that has not been one of our bareboat deals that hasn't ended up in problems. Either some problems during the charter or a full-fledged Chapter 11. So I think that's the tricky part in an industry who have been accustomed to lever up the assets, and where banks and others or fund providers have been willing to do really high leverage in industries where they should really stay away from leverage. So combining operational and financial leverage has been but sort of defining this industry and why it has become, I would say, not so investable, as an asset class for many investors. So we are really now, we're doing more than 90% time charters where we control the assets and where we have direct interaction with the end users. While if you are a financier provider, whether it's through a bareboat or through a loan, you typically would fund the intermediaries. Because the end users, like the Maersks or the Volkswagens or those kind of guys, they don't want to borrow money from any of us in reality. They want a different service product. So we are taking more risk, and then the question is, when the market now is coming up, the market is peaking, it's getting very tempting to lend out money at elevated values, isn't it?
So Ole's right, and the rest of the panel are not so right. Or is that?
Sorry if
your model is right, and everybody else is not so right, or?
I think maybe just to respond to Ole or Bob. We, as I mentioned in my intro, we're very kind of cyclical. So maybe we go a little bit higher on the LTV curve at that time. But it's with the expectation that the market at some point will actually turn in the right direction, not the opposite. So the one discipline we're very, very focused on is to make sure that when something moves too high, we back off. And that discipline is absolutely key. And that's something I actually learned on the banking side. Now, one of the reasons I actually left banking when I did was that the regulator typically wants you to lend more when the markets are high, because they're focused on cash flow. Something Harris as well is very familiar with. We actually used to work together. The great thing about being in a fund structure is that we don't have the regulator telling us what we should be doing or shouldn't be doing. So we're able to do this in the right way, which we believe is being counter-cyclical. So yeah, the LTV, we're willing to do more, but when the value is also very, very low.
Well, there are different horses for different courses, Ole. And the reality is that it depends a little bit on who do you define as your client. So our clients are the ship owners, and these are the people that we try to service. These are the people that we try to make successful by helping them achieve their growth ambitions. And you don't do that by competing with them and offering time charters. So that's not our business model. Actually, that's why we're in, leasing, financial leasing, operating leases occasionally, and that's what we're here to do. So,
I mean, all of you sort of offer quite flexible sort of solutions, and deliverability of this sector's sort of always been something that has been really strong. So you've been competing in situations where, others might not be able to deliver in the kind of time frames or the kind of LTV or the risk kind of matrices that you guys exist in. And so that's always been a very, very strong part of this market, I think, and the solutions that you've offered. But are we in a situation now where ship owners are just making too much money? Is that an issue for your kind of businesses, or how do you get ship management teams interested in the solutions that you guys provide?
I think that comes along with, I keep harping on the kind of cyclical approach, but we have clients that are buying currently, for instance, in the dry bulk market, even though it may not be at a very, very low level historically speaking, but it's certainly down from the highs that we saw last year. So we always have clients that are looking to renew their fleet or expand their fleet when the market is a little bit tough. So that's where we step in. Another very good example right now is the offshore sector, as Christoph alluded to. Another reason, which I didn't mention, why we actually love that sector now is that the banks are running for the hills. They just do not want to touch that sector. So the less competition, the better for us, more opportunities. And we're dealing with companies now in that particular sector that we never spoke to in the past because there just isn't any bank capacity. So that's how we actually keep deploying capital, finding these areas where there really is very limited competition. And looking at the panel here, it's interesting because we never really, or very rarely, run across each other. It's a very, very large market, very broad. Maybe have a different geographical approach. So in terms of competition, it's such a large market that we rarely actually run across each other.
I think I can only but echo what you're saying, Svein. In fact, I agree with your comments on the offshore market. We covered this a couple of days here at an offshore panel. I think you're absolutely right. I think the cash flows are there to support what we're doing in terms of lending in the offshore market now. We're focusing exclusively on ship-shaped offshore markets like PSVs, anchor handlers, deep sea construction ships. We're not veering towards drill ships or jackups. We don't have the capabilities. But to the extent that we have taken the strategic decision to move in there, we're also backing it up with additional know-how and skill set. We just recently signed up Lars Solbakken, the ex-CEO of Offshore Yield, who's also an ex-colleague of ours. So we go back a long way, and additional technical staff to back our efforts in the offshore. And in addition to that, when it comes to the opportunity set today, I think the dry bulk market is quite interesting. I think there's a disparity between earnings and values. And that's where the traditional banks find it difficult to actually follow through with the requirements of the ship owners that need a little bit of higher leverage to make sure that they're able to fulfill their goals, but also flexibility in terms of repayment and the cash flow management. And that's what we're here to offer.
Yeah, you just alluded to in your introduction that this obviously is a very good time for shipping. There's a lot of cash around. When I was at North Shipping, one of our investors I was speaking to was saying, I'm sure in Norway it's like party time. It's like crypto in 2021. And I said, yeah, it's pretty much party time, but I'm sure in crypto, and there are a few, compared to shipping, there are a few more women in the room. But joking aside, it's obviously it's at the moment a very, very good time. Everybody's enjoying themselves. I think the only guys who are complaining are potentially the bankers, because they don't have enough lending opportunities. For us, it's obviously in some sectors the same. Generally, liquidity is very, very high. Profits are very high. Leverage generally is very low, and there is less lending requirements in some sectors. At the same time, however, we have obviously seen changes in the behavior of banks. Some banks just generally don't want to finance anything older than 5 years. they don't want to finance certain sectors. ESG or Poseidon Principles or other things have also started to really limit their appetite for certain parts of shipping or shipping in general. And we are filling part of that gap. So while maybe overall lending volumes are down, certainly I think for the players like us, we have been able to continue to find good lending opportunities in this market. Of course, it's more difficult in this market sometimes to give high LTV financing because asset values are high. So if we do higher LTV financing, we generally want to see some secured cash flow around those higher LTVs. But in general, we continue to be quite constructive around all these sectors and our ability to lend. The other thing is obviously also our capital has become more attractive compared to banks because we are total return focused. So with the SOFR rates where they are, our capital actually is marginally more expensive only than bank capital, but we are able to give higher LTV still, give longer durations, give much more structuring flexibility around it. So that has certainly helped us in the last 24 months that our capital now is relative competitive compared to banks.
Yeah, I totally agree, and I think that's maybe the big change now. With the spreads, I mean, as most of you, I'm sure, have more absolute return requirements and not relative to underlying interest rates. If you go back a year or two, you probably had to go, I wouldn't say down at the bottom of the barrel, but you certainly had to go down a little to find customers who were willing to pay that extra spread to get to the funding, over what you would get in the banking market. Now suddenly this has changed. Now suddenly it's just a marginal difference really. So then you're down to effects and a value of structuring and having more flexibility in the funding. So from that perspective, it's become much more relevant for a wider group of customers, I would say, than it used to be.
How important for you, Ole, is the execution part as a CEO of a public company in terms of deliverability, predictability, and efficiency?
It's extremely important. It's like if you go with a bond. I mean, you have to make sure that if you go with a bond and it fails, it will hurt you because the next bond is going to priced very differently. The same thing if you go and raise capital, going with something that sort of fails, is a problem. But I guess working with any one of you, I mean, it wouldn't be sort of a public exercise. So you could say if the funding does fail, it's not like everybody would know about it and read about it in TradeWinds. So from that perspective, it's easier. But I would say both execution, ability to do deals with size, so you don't have to go and syndicate, has a value. But at the end, it's down to relative cost and I would say. For us, if we would go to any one of you, it's a balance, right? Our focus is to maximize dividend per share, and the dividend we can pay is a reflection of also of the funding we have, amortization profile, and the structure of the debt. So the more the merrier in dividends. I mean,
we've heard from you, Ole, and Christoph about higher funding rates and how they're helping your businesses, I think. Harris, is that the same for you? Are you finding these higher funding rates a benefit when you're out there competing in the market, or?
Well, I think it's sort of Goldilocks time for what people call alternative lending right now, because the base rate is higher. Spreads have sort of increased across the board, I would say. So I think the combination of those two factors make it quite attractive. But we need to ensure that it also stays attractive for our clients. So that's important.
Yeah, I mean, it's definitely helped us in terms of broadening the market, more clients. The other thing that I should mention is that our fund, we're not levered, so we have no leverage in our fund. So we're really seeing the benefit of that right now because we're not relying on back leverage to get to our returns. Obviously, the back leverage now doesn't work the way it used to when it was almost free money, and it's also less of it right now. So that's also helped to drive our funding right now, or our deployment of capital right now.
But I just wanted to add, though, to what Svein said, that we see the relationship between banks and leasing, at least as a symbiotic relationship. We don't see ourselves competing necessarily with banks. We see us as a conduit through which banks also can achieve their purposes. And the fact that we are based in Europe I think adds some additional credibility and longevity to the type of capital we're offering. And we see the benefits of that right now because, what has happened over the last, few months or few years, there is a definite decoupling. We see that really having a more significant position in people's mindset when they make their financial decisions. So I think that's something quite interesting to watch.
Okay, so we started with what got you out of bed in the morning. What keeps you up at night in our last couple of minutes? What are the kind of risks and sort of areas of concern you see in the future, and how are you guys positioning yourselves to take advantage of those or to protect against downside? And maybe we start with the far end on this time.
With the guy with the gray hair? Yeah. Well, we've been doing this for a few years. It's a lovely cocktail of greed and paranoia. If you're not greedy, you won't get anything done. But if you're only paranoid, nothing gets done either. So it's all about trying to do the right deals over time, mindful of cycles. We have a diversified asset approach, as you do, which I think is a good strategy in markets with extreme cyclicality. Our good friend Hebron Hansson, he sometimes carries around a little notebook or a calendar from 1973, Norwegian Shipowner Association. There aren't many names left that were, at that time, sort of the big names. And that sort of illustrates a little bit the cyclicality of the business we're in, and we shouldn't sort of underestimate that. But now everybody's making money, and it's boom times. So, I wouldn't say, you shouldn't, if you really want to sleep well, you should invest in SFL stock because of the diversification and because we do pay dividends all the time. But otherwise, it's a pretty interesting time. As I said, nobody's bankrupt. It's almost spooky.
Yeah, I would say also I sleep well at night, and we also have a diversified portfolio. You have a diversified portfolio in your way. We have a diversified portfolio on our side as well. What sometimes can keep me up at night, or what I'm thinking about, is more around our business model for most of us here, maybe for you a bit less for Ole, but we are obviously attracting institutional capital to invest into the maritime space. And while maybe 5-6 years ago we probably could have talked to 50 private equity funds or institutional investors here in New York, that has probably shrunk to about 15. Why? Because of ESG. So shipping is viewed as a bad industry. We recently had some discussion with an infrastructure player, and he wanted to invest into shipping. And we then discussed the various asset classes. He said, well, we can't do crude. We said, okay, can you do product? No, product we can't do. Can you do chemicals? No, we can't do chemicals. Okay, can we do investments into LNG? No, we can't do LNG. Okay, can we do dry cargo where the vessel might be on charter to cargo, but cargo might still transport coal? No, we can't touch coal. And we said, well, I don't think shipping is for you. And this is something where in Toepfer of Trump, he said it yesterday as well, where because of ESG, we are under investing into potentially fossil fuels. We have a depletion rate in oil fields that is much faster than the demand decline, and that will keep therefore prices high. Now that's obviously the issue of that side, but in general, institutional capital finds it more and more difficult to invest into this industry, which is not right, and that may be just overreaching a bit, but it may eventually decline a bit again. We have seen here in the US that some states like Oklahoma, Florida, and Texas have mandated their state pension funds not to make ESG an investment criteria, which is quite interesting. So we see some drawback or some scaling back of it, but at the moment that's the only thing what we sometimes wonder where all this capital is supposed to be coming from, that we need to renew the fleet, because we need to renew the fleet to decarbonize.
Well, I didn't sleep well last night, but that's not because of ESG considerations. It was probably because of all the parties that Marine Money thankfully organized. But other than partying, I think what's important right now is, as you said, the decarbonization. And what's in our mind is the effect of it to the existing fleet, because we have billions of dollars invested in assets that may or may not be obsolete in a few years from now. How do you deal with this as an owner and as a financier? So that's something which is high up on our priority list. But at the same time, the world's biggest problems are the world's biggest opportunities, and we see this decarbonization drive as a massive opportunity ahead of us. People are talking about billions or trillions of dollars. I mean, it's definitely big. And we also need to make decisions about fuels, about propulsion, and these are issues that we definitely need to think hard about. I'm a big proponent of methanol because I think it's a great and easy fuel to handle, and the infrastructure is more or less there that would allow us to do it. But this panel isn't about propulsion methods, so I will rest my case there. Thank you.
Well, you know, I actually slept great last night. Probably the best I've slept in years. So
get a life.
Good point. So we actually have a very, very broad institutional investor base, and the largest overall capital actually comes from pensions. And especially early on, I think what kept me up at night was that we were actually responsible for investing the capital of pensioners around, particularly in the US. We take that very, very seriously. We want to make sure that we do well by them. And that's why we're so focused on protecting the downside in everything we're doing. Hard real assets, securing these loans, making sure we're counter-cyclical, which I've been saying several times. So we used to get that question a lot, particularly early on, what keeps you up at night? And when I get that question now, I basically say that we've actually just lived through it with the pandemic. It's hard for me after 36 years in this industry to see something more disruptive than that. And we managed to do that well. So I think we're actually seeing the worst that well, should never say that, but probably in my career. That was a very, very tough period for all of us, and we got through it. So, and then shows the resilience and the importance of the maritime industry. And in a way, what's happened with COVID is that it created a lot more awareness of the industry itself. Maybe not for good reason with the supply chain issues, but there's more awareness, and that actually helps us in terms of fundraising. A lot of investors in the US are actually more aware of the industry now, which makes it a little bit easier for them to actually allocate. So we're very, very optimistic about the future on the capital side.
Fantastic. Well, we're out of time. So Svein, Harris, Christoph, Ole, thank you very much for your time this morning. Enjoy the rest of the conference, everybody, and thank you very much.